So your bookkeeping it is important because you want to make sure that you're making money, right? You're actually profitable in your business because you might know, okay, I'm busy, but am I actually, making money? You want to make sure you know how much you owe to your suppliers and your vendors and whoever you owe money to. You want to know that if any of your customers owe you money, you want to be able to know kind of who owes you that money and when. You want to keep track of your, sorry, it looks like a few people can't hear me, so my mic is not muted. So it looks like some of you potentially maybe having issues, so hopefully Joseph can work that through. We want to make sure that your GST and your PST and your payroll source deductions are all getting paid on a timely basis, right? CRA doesn't like it if you're not paying them when you're supposed to. So it's the same thing there with being, make sure you're being tax compliant. And then we're going to talk about the financial statements and how you can kind of get them made and help your accountant in getting those financial statements done up. All right, so there are a few different bookkeeping programs. So there's QuickBooks, which you can get the desktop version, or you could get an online version for those of you that are going to be out on the road and whatnot and need to be getting your statements and all your bookkeeping done. Same thing with Sage, or as you may have heard it also called Simply Accounting. There's the desktop version, and they have come out with an online version as well, which lots of people don't really know about, but it's kind of cool too. So same thing, you have access on your phones, on your iPads, on pretty much any device possible wherever you may be. Some people still use the manual synoptic or an Excel spreadsheet to kind of keep track of all their bookkeeping and everything that's going on. Or you could even get your own specially designed program. There's tons of different companies out there who will set up bookkeeping programs and get it specific for your business. Okay, I'll kind of try watch the chat once we get going a little bit farther in. Depending on what questions there are, I'll see if I can answer them as we're going, and if not, we'll just wait till the very end, and I'll leave a bit of time at the end for answering questions. Okay. So the first thing when you're creating, your QuickBooks, your Sage, or setting up your chart of accounts. So this is all all of the accounts that you may possibly use, and then if you're using QuickBooks or Sage and they have the templated, there's even some accounts in there that you're not going to use. So you can kind of go through and pick and choose the ones that you really want, and you can condense, especially in like your revenues and your expenses. You can have as many or as few as you want. So it all depends on how much detail do you want in your financial statements. Okay, so you can pick and choose a little bit and use just purchases, or you could have different types of purchases in your expenses. For like your office expenses, maybe you're going to have your supplies and then like your postage, but you could combine them together as just being office expenses, all right? So there's 5 main categories within that. So there's your assets. So that's everything that you own or that is owed to you. Your liabilities, so that's what you owe to other people, other companies, other whatever, CRA. And then your equity is kind of what's left after you've gotten all the money from everybody you're going to get and you've paid everybody you owe. The equity is kind of what you're at right now. So then there's the income, so those are all your revenues, any kind of money you're getting from people on like your daily sales, and then your expenses. So the expenses that are getting paid out on a regular basis. One tip is to use account numbers. So that's where I have like those example numbers there. That's really helpful for your accountant if they're using a program and they're creating they're using account numbers. It's really helpful if you guys have the exact same account numbers in case the terminology is a little bit different. Like maybe yours is called like checking, whereas they just call it like bank or something like that. So if you have account numbers, then you know, okay, that is a specific number to that account. And then if you change your account names throughout the year, but you keep the account number the same, then that really helps kind of maintain. And then same thing if you get a new account created by your accountant, if they use the account number, then you're less likely to, for example, income tax. If there's income tax payable, income tax expense, you might accidentally put your income tax expense in your liabilities in your payable section if it's just called income taxes. So if you use like your 1000s are kind of a common set of numbers for your assets, the 2000s are common for your liabilities, 3000s for the equity accounts, 4000 for your income accounts, your revenue accounts, and then 5000s for the expenses. So it's very common among all the different kind of accounting programs out there, but they can be changed to fit whatever you like, whatever makes the most sense to you. All right, so then when you're setting up all those accounts, these are the kind of the debit and the credit rules. When you're doing your bookkeeping, your debits always have to equal the credits in all your journal entries. So you can see that one example over there, the journal entry for advertising. So it's going to credit the bank. The money is coming out of your bank, and then it's getting paid to a type of expense. So your advertising expense is a debit of $106, and then the GST that was paid is $5. So we'll talk a little bit more about GST and what how that's recorded, but that's kind of showing you your journal entry that the debits and the credits do have to be equal when you're doing the journal entry. And then with that, keep in mind that the bank, when they give you their bank statement, they're doing it from their side. So the debits and credits are a little bit different than what your debits and credits will be. They kind of trick you in when you have that going on. So with the rules there, generally for your assets, increasing assets when the bank is going up, it's a debit. And then when you're going down, it's going to be a credit. And then your liability and your equity is the opposite. And the revenues are the credits and your expenses are a debit for going up. So for that example there, the money's going out of the bank, it's crediting bank, debiting expense. Both of them, so your bank is going down, so it's a credit, and your expense is going up, so it's a debit. Okay? And same if you're depositing money into the bank because somebody is paying you for an a service or your products, then you're going to be debiting your bank because the money is going into your bank account account's going up, and you're going to credit your revenues. So you're getting more sales, so your sales are going up. So that's the debit and credit side there. Okay. So then with those account types, that's how we get our statements. That's how we're going to get our balance sheet and our income statement. Okay, so on your balance sheet is your assets, your liabilities, and your equity. So then the balance sheet is a moment in time, and it shows everything that you own or something that has that's like either the cash or your future value, so your assets. It shows what you owe, and then it shows your equity. So that's, like I said, the kind of your final balance after everything's been received and paid out. Okay? The income statement shows your revenues, so anything that you've sold, and then your expenses. So that's where you're going to get your profit. So I think we'll get to this guy. So this kind of just shows that flow. So when you're doing your transaction and you're saying, okay, what am I crediting, what am I debiting, then it goes into your different types of the accounts, so the assets, liabilities, and equities all go to the balance sheet. Your revenues and your expenses go to the income statement. Okay. Hopefully that kind of makes sense, the debits and the credits and which accounts kind of go to the balance sheet and the income statement. Okay, so in your financial statements then, so the income statement is kind of the one that you'll look at the most. You'll tend to look at this on a more regular basis because you want to make sure, am I making money, right? So the income statement, you can pick over whatever kind of period you would like. You could do over the month, you could do over a quarter, you could do over the year. So it kind of shows you within that specific period of time, is the business making any money or is it losing any money? And this is like what we saw in the previous slide. You know, all your income statement accounts are all going to be there, and all your expense accounts are going to be there. Okay, so then the other account, your balance sheet, this is the one that you pick a specific point in time. And at that specific point in time, that's everything that the business owns and everything that the business owes to somebody else at that point. So generally, most times you'll look at that is at year end. So when you're at year end, your accountant's going to want to know, hey, where you're sitting. Your banker is going to want to know kind of where you're sitting. So they'll always they tend to look at your current assets and then your current liabilities, so that they know where are you going to be getting money in right away, and then who you're going to have to pay out to get paid out right away. Okay, and then so the trial balance, that one, it's kind of a combination of the two. So it shows all of your accounts at a particular point within a fiscal year. Same thing, generally you're going to pick just kind of that year end and look at that account. And it'll show you all of your assets, all your liabilities, all your revenues, all your expenses. And it's just at any point in time, it should kind of save that account, that balance. And so I see one question here about how much somebody should put away for income tax. If you're a corporation, then and you're making under like $500,000 in the year, that's the small business. Generally, it's about 13% is what your tax is going to be. But that is, give or take, there are some amounts that get added back and deducted on your tax return when you're actually filing the taxes. But approximately 13% of your net income for the year is what you're going to want. Okay, so getting into a little bit more detail with the income statement. So the sales are going to be any revenue that you generate from your products or your services, less returns and discounts. So if you're doing generally returns of items and whatnot, you can have, like I said, a separate account if you wanted to show, here's my sales, and then here's whatever returns I've done in the year, because maybe you want to see what you generally, get returned every year. But if you would like, you can just net out your returns within your sales account. On your financial statements, on the income statement, generally they will get lumped together, but you can have them separated out just so it'll help you out. Okay, then in the cost of goods sold, so these are your costs that are directly associated with those products that you're selling. So if you were buying an item to sell, then that would be a direct cost. So that would be your cost of goods sold. If you're using a whole bunch of widgets and whatnot and you're building something together, and then you're going to be selling that, so that's the same thing. So you're going to have your parts, you're going to have your labor. Those are the direct costs associated with making that product to sell. So lots of times you'll see on financial statements where we have the sales, you'll see the cost of goods sold, and then the net of those is your gross profit. So that's when you're actually selling an item, that's how much you sold it for, and that's how much it cost you to make it. So that's your gross profit on those items. Okay, so then your operating expenses, those are all your other expenses, your overhead, the things that aren't directly related to the sales, but it still costs to run. So your rent, your insurance, any kind of office supplies. So any of those are your wages, any expenses that you need to operate your business but aren't directly associated to selling of a specific item. Okay. So then with those expenses, you also want to keep in mind anything that doesn't get used up in a year. So if you're buying paper and pens and whatnot, that generally you're going to be replacing it within the year. But if you're going to buy a desk or a photocopier, those like pieces of equipment that last a bit longer, you're actually going to want to capitalize those or put them on your balance sheet, and they're going to be an asset. So we'll talk about that on the next slide. And similarly, like your insurance. Generally, your insurance lasts 1 year, but depending on when your year end is, if you're paying for it, at the end of the year, then it's actually technically prepaid for the next year. So you kind of have to keep that in mind, that there could be some things that aren't actually expenses within the year, but they are operating or they're assets and should actually be on the balance sheet. So then once we get to the balance sheet, oh, sorry, I see one more question there. Measure services. Yeah, so generally there wouldn't be a cost of goods sold if there's services on your income statement. And then same thing, the value. Next question there, the value of the asset should be on the balance sheet. Commonly, yes, 500. But you kind of have to think about the item too. Sometimes there will be things that are over 500 that they do really get used up within the year, so you could expense it. And sometimes, if you're a little bit bigger business, maybe $1,000 is your limit. So it's a little bit of a judgment call, but you roughly, yeah, I would say that 500. If you have a business that sells, I'm going to go back a slide here, just so you guys can kind of see. So if you're selling both goods and services, you are going to have both lines of sales, and then you'll have your cost of goods sold. So just as long as you distinguish which revenue you have, so these are like product sales, and then you could have your service sales. So you'd either have them both at the top, and then your cost of goods sold is a little bit, your gross margin, is going to be a little bit off. So then potentially you might want your sales in the other income section just to keep them separate so that your gross profit is strictly your product sales less your cost of goods sold is your gross profit, and then you'd have other income. But I have seen on some statements where they just put both types of income together and just kind of separate and distinguish them on the statement. So hopefully that answers your question there. So then on the balance sheet, there's, like I said, the three categories: the assets, the liabilities, and the equity. So your current assets are anything that's going to get converted to cash within 1 year. So your bank account, it's cash that year. Generally, your accounts receivable, so anybody that owes you money, hopefully, they're going to pay you within 1 year. So that would be easily converted to cash. And then your fixed assets are anything that's going to be longer to either convert to cash or to use up their value. So sometimes if you have investments, sometimes they could be a little bit harder to get to cash. If it's a GIC, it's locked for a year or 2 years. That would be a fixed asset. Or any of equipment and vehicles and buildings that are depreciated, because their value generally they last 5, 10, 15, 20 years. So you slowly depreciate them over time, and then you take in the expense year after year. So that's what I was saying, like that with the 500 mark. $500. So if you expense in 1 year, CRA is not going to ask anything about that. They're just going to be like, yep, whatever, that's an expense. But if you bought a truck that's generally going to last you a little bit longer, you're just going to take the expense a little bit over the next 10 years or over 5 years or whatever you think the value, how long is that vehicle going to last at that price. Okay, and then the liabilities. So we have similarly, you have the current liabilities, so that's anything that's going to be paid within the 1 year. So your GST is going to be payable within 1 year, PST, payables to your vendors, so anything you're buying, your supplies, those are all current. And then your long-term liabilities are the ones that last a little bit longer. So the loans and the mortgages, shareholders loan, if you're personally putting money into the company and you're a corporation, generally you're not going to pay yourself before you pay everybody else that needs to be paid because you're investing that money into your company. And then the equity, so this, like I said before, this is what's left, kind of the net ownership of the business. So if you were to shut your doors and be like, okay, I'm done, you're going to get all the money in from anybody you can and selling off any items that you have left over, your inventory, your fixed assets, and then you're going to pay out everybody that you need to pay out. And then generally what's left in the bank should equal your equity. So that's kind of what is left at the end. So you can't necessarily say, okay, this is what I'm worth. Some people will have that thought that their equity is, well, this is what the company's worth. But just because you have a piece of equipment or something on the books, like the cost was, $200,000, that doesn't necessarily mean that you're going to get $200,000 for it when you sell. So it's not exactly equal to, what the company is worth. You still would need to do some sort of valuation, but that's a completely different topic on its own. Okay, and so in the next couple of slides here I have some examples of what all these the three different statements look like. So the next guy here, this is the trial balance. So you can see it's all of the accounts that we have that have balances in them, and then even there's some that have a zero balance. So when you're pulling your reports out of QuickBooks or Sage, you can say, hey, show me every single account I have with zeros or not, or you can say, hey, just show me the accounts that have balances in them. Okay, and then this is all nicely sorted, the assets, and then the liabilities, the equity, the revenue, and the expenses. You can see none of these guys have account numbers on them. So if you're going and you're looking at this statement, this trial balance, and all of a sudden you see the advertising is up sitting beside your bank, then it's like maybe you accidentally set it up as an asset in your bookkeeping program rather than setting up it as expense. So that's one of those examples that, potentially if you had an account number, you'd be like, oh, I need a $5,200. That's going to go into expense. And then you're less likely to accidentally put it the wrong account type when you're setting it up in your chart of accounts. Okay, and then you'll see at the very bottom, so we have our debits. So these are the common, right, the normal balance of what they should be at. And then our credits, so those are all at their normal balance. The debits equal the credits, always. Most accounting programs won't allow you to not have your debits equal your credits. Sometimes there might be a glitch and something does happen. So you're going to want either to figure out what happened and where that went, or get somebody to help you figure out how we glitched. If you're doing it manually in Excel or in a paper synoptic, then you're just going to want to make sure that when you're transferring all your amounts from your revenues and your expenses into your balance sheet or your trial balance, that you are making sure that everything is balancing at the very end. Okay, so then on this next slide here, you can see a copy of a balance sheet and a copy of an income statement. So we have it separated from our current assets. So we have the bank, so that's how much money is in the bank. And it's not necessarily the money that's actually in the bank account, but it's how much is available. Because if you've written any checks, you're going to have credited the bank and debited whatever expense, advertising, wages, or whatever. But it's possible that those checks haven't actually cleared the bank yet. So they're already going to show in your balance sheet as taken out of the bank, but maybe there's actually more money in your bank account just to cover that. So you're going to want to make sure that you're looking here to see, okay, how much money do I actually have to write checks if I've already written checks and distributed them. Okay, so accounts receivable, so that's what is owed to you from all your customers. if you're using the sales module, or if you're recording your revenue as you're selling it before they've paid, you're going to want to make sure you set up that receivable. At least you want to know a list of, hey, these are the customers who have not paid me for whatever I've sold to them. And then we have those fixed assets, so our furniture and our computer. You'll see lots of times there'll be a cost account, and then there'll be accumulated depreciation or accumulated amortization. So that's what I was talking about when you kind of depreciate it a little bit every year. You'll generally have two accounts. You're not going to want to reduce the cost of the item because you want to still keep track of what you paid for it when you bought it. So you're going to have a separate account showing, hey, this is how much I've taken off every year. So the net of them together should be the net book value, so the value of that item if you were to sell it, or fairly close, just based on whatever amount you decided to amortize it by. Okay, and then that second section, so our liabilities. So everything here is all current. So we have just our payables to any vendors that we have. There's the GST, the PST, and your source deductions. I also like to have sometimes a GST collected account and a GST paid account. So you'll sometimes see two accounts there showing, okay, this is how much I owe to CRA for what I've collected and how much is paid. So these accounts, those three, the GST, the PST, and the payroll, you'll kind of want to know generally how much is payable, because technically that money, it wasn't yours that you had received, right? You collected it on behalf of the government. So it's even sometimes nice to have a separate bank account if you're somebody who, tends to see the money in the bank and it's like, okay, I'm going to go buy a new truck, or I'm going to go buy a bunch more supplies because I want to sell much more. Sometimes it's nice to have a separate bank account to put that, like the equivalent amount of cash in. And then it's sitting there and it's like, okay, that is the GST I've collected. That's what I owe to the government. That's the PST I've collected and owe to the government. The payroll deductions that I've taken off my employees' checks and I owe it to the government. So if you're paying it on a regular basis every month or every quarter, you're less likely to, accidentally spend it before it's due. If you have a separate bank account, you just kind of move it over. I'm going to get to your PST question once we get to those slides a little bit later on. So I have seen you, and I will get there. In the equity section, so this is, like I was talking about, what money the company has, or the owner has put in, and so what would be paid back to them after everything else has been paid. And then the current earnings is, you'll see on the income statement, that is the current period's earnings. So that amount agrees, the $1748.75, because that makes up the equity, because that's all the money that we've earned in the year. So that'll go into our retained earnings, or the equity. Okay, so then on the income statement, so this one you can see here we have the product sales, the service sales, so there's our total revenues, and then our purchases, so then our gross profit. So that's where I was saying that in this case we're showing both two different types of sales, and then whatever we purchased in the year, so that's kind of our gross profit for what we've sold and what we've kind of had to pay to get there. And then all the other daily, costs and expenses. So for this period of this little company here in April, they're making money of $1748. And then there's a nice little bubble on the side talking about the GST and the PST. So that is your total revenues that you're going to report on your returns. So if you're doing it, if you're a monthly reporter, quarterly, or annual, Just make sure you're pulling your statement for the right period so that you're telling CRA or the ministry, hey, this is how much I sold in the month or the quarter. So that's where I'm calculating my GST off of. For the GST that has been collected yet, that will be in the liability section. So any GST that you've collected, your payable, is going to go in your liabilities. GST paid, or if you have a receivable, that's going to go into your asset account. And for your sales, no, your GST and PST is not included in that number. That is the subtotal. So this is how much I was selling the item for, and then that's your money, right? That's what you're selling the item for. And then the GST that was collected, or the PST that was collected on the item, is what goes into your payable section. So in back on that one previous slide where they were purchasing, we had seen that the money was coming out of the bank, and then the subtotal of the item that was purchased went to advertising. So it's the 106 in advertising. And then the ITCs, the GST that was paid, went into the GST payable account. So you can, like I said, have your GST in one account, you know, your ins and your outs, and that's your net payable, or it could be separate and have two accounts. Okay, so this is where we're talking about that GST, the in and the out. So you could have your credit account for your GST charged on your sales, so that's your payable, and then anything that was paid on purchases, you could have as a separate account. So when you're adding them together in each period, you're going to want to have your, whatever you were collected is owed to the government. The GST that you've paid, you're going to get back from the government. So you're going to net them together. So if you have a result where I have collected $500 and I've paid ITCs of $100, so you have $400 more that you've collected than what you've paid, so you owe that to the government. But if you only collected GST of $500, but you bought a whole bunch of stuff one period, and so now we have ITCs of $1,000, or your GST that you've paid is $1,000, so now you have a negative $500, so you're actually going to get a refund of $500. So that's where I'm saying sometimes it's nice to have two separate accounts, because you can see both lines. Okay, this is what I've collected, and this is what I've paid. So it's a little bit easier to see, am I going to be on the asset side, am I going to be in a debit position, a refund position, or am I going to be on the liability side, the credit position? If you have them in the same account, you'll just need to look at the general journal, or GL, general ledger. You'll hear that terminology a little bit. You're going to want to look in your accounts and see, okay, this is all of my credits. This is everything I've collected. Here's all my debits, everything I've paid. So you can see it in one line, hey, this is what I owe or what I've received. But you're going to, when you're reporting it, you're going to have to do the math to separate it out. Okay. For your PST, it's a little bit different in that you only get you're not going to get credit for any PST that you've paid. So when you're collecting PST, so if you are required to collect PST off of your sales, then that all is owed to the ministry. Okay? If you buy anything, if you're buying paper and pens or whatnot, and you're paying the PST, that money is just, it's gone. You don't, unfortunately, get it back. So when you're recording those entries, you're actually going to add the PST to the item. So you're going to have, okay, the advertising. The advertising was $100. I paid PST of $6. So in is $106. And then the GST that was paid goes into its account. But the money that came out of the bank was $111. Okay? So basically it's whoever gets paid at last is going to remit it to the ministry for PST. So like I said, it's a little bit different that you're paying it to whatever the supplier, and then the supplier is going to remit it to the government. If you buy anything out of the province, you don't have to pay PST, right? If you're going to Alberta, you get a deal. You don't have to pay PST. But as soon as you bring it into the province of Saskatchewan, you have to pay the 6% PST. Generally, that happens if you're buying like a vehicle or whatnot. It's going to be calculated when you do your plates, right? If you go and you pay your plates, they're going to say, hey, where did you buy it? And then they charge you the PST then, and that's when you're remitting it. But if you're buying something to sell from out of the province and they didn't charge you PST, then technically you're supposed to self-assess your PST, and then you would just add it in to your PST payable account, and then you're going to pay it. So if you're bringing something in from the States, you are going to, when you go over the border, if they decide they will sometimes collect or get you to pay the GST and the PST, and sometimes they don't. So it all depends on, I think, which border crossing you're going through or the duty. I'm not 100% sure on that one, who kind of decides when they are not. So if you don't pay, GST or PST when you're crossing over the border, then you should be self-assessing PST on that, and then adding it. So then you're going to add it to your sales, whatever I'm purchasing, and then reducing. Sorry, I kind of got sidetracked there. You're going to be increasing, so you're going to be crediting your PST payable, and then debiting your purchases, because that's what I purchased. So you're adding it to your expense account for what was purchased. Okay, so there are some services and some products that you don't have to collect GST or PST on. So these two websites here, if you go to them, it's fairly easy to kind of follow through. They have all the different reports on there. So you kind of pick your category. It's like, okay, I'm in, whatever category, the medical, massage. Then it tells you, hey, this is what I do or don't have to collect GST and PST on. So I would definitely recommend going into that and just have a good idea of what you are required to collect on, just to make sure that you are remitting it, within the time that you're supposed to, because you don't want to end up getting audited and then them coming and saying, oh, hey, you didn't collect it, but you still have to pay it, because then that's just coming out of your pocket, versus if you're supposed to, then you're going to be collecting it from the customers and then paying it. So it does vary from, different categories or whatever, different types of sales and services that you have. Okay, so then kind of the last little bit of kind of tips or whatever that I have is that you want to make sure that you are recording everything. Okay, so one of the easiest ways to do it is to just record from your bank statement or from your credit card statement. And you want to kind of do this on a regular basis. So every month you decide, okay, let's go and make sure we recorded everything from the bank statement. So you're going to go through and make sure, okay, I have all my deposits, all my sales, anything I purchased, whatever, and then make sure you're getting in anything else that it's like, okay, I didn't do, record the checks for somebody. So you just make sure that you're getting that in there. Your interest in your bank charges or anything that you're paying with a debit card or credit card, those purchases don't necessarily make it into the system right away if you're doing, your checks or your payroll modules. And then once you're doing that, if you know that, hey, I've recorded everything off the bank statement, So I have all my revenues in there, I have all my expenses in there, and your bank is reconciled, generally that means that you have all of your revenues and your expenses are all going to be recorded. So it's kind of the easiest thing to do is just make sure that you're looking at your bank and your credit card on a regular basis and be like, okay, have I paid everything, or have I recorded everything that I've paid or collected? And that helps kind of make sure that you're actually getting it recorded. So I would, make sure you're doing it on a regular basis. So if you're really busy and, you're constantly selling stuff, then maybe you're going to want to do it on a weekly basis. Go online, print your bank transactions for the week. If you're, not quite as busy and it's like every month I have, a whole day when I can just sit down and record everything for the month, do it for the month. Maybe you're in, a business like construction where, you're really only busy in the summer. So in the summer, maybe you're doing it every week or every month. But then in the winter, it's like, well, I'm only going to wait, I'll wait till year end. And I'll just do the last few months over the winter altogether. And I'm just going to do it over that quarter. So it's just kind of depending on how busy you think you're going to be. But you do want to make sure you're on top of it so you don't forget to do something. And you don't want to forget how to do it if you're, using an accounting program that you're not really used to. So kind of the last little bit here is, make sure you're being proactive, you're getting things done on a regular basis. And if you're, comfortable and have your bookkeeping all done, then you're going to have more time to actually do what you love and what you got into the business for. You're wanting to sell these items. You're wanting to, do these, services for people. You want to help people and do your thing. So if you kind of get that under wraps, then you're not going to be so stressed for, a whole month when you're trying to do your taxes at the end of the year, or dealing with the accountant being like, okay, well, what deposit is this from, or, where did this money go? And you're like, oh, I have no idea, trying to flip through a shoebox that has all your receipts in it. It stresses you out, and that's no way to live there. So I guess that's it for the presentation. So now if you guys have any more kind of questions and whatnot, we can spend the last kind of 5-10 minutes here going through any others that if I didn't kind of really go into enough detail there. So I think I see, so the balance sheet debits and credits, Donna, do you still have a couple of questions on there? For dividends, if you're going to be paying out dividends, it's actually going to go into your equity section. So there will be just a separate line called dividends paid. You can always throw it into your owner's withdrawals, and then at year end with your accountant, decide, okay, how many dividends do I want? Because from your personal tax side, maybe you don't want more or less, dividends, especially if you're a corporation that has like an off calendar year. So then you can kind of make sure. So if you're recording dividends every month or every quarter, throw it into your equity section, or like I said, into your owner's withdrawals, and then decide with your accountant what makes the most sense for a tax perspective. Okay, I'm going to go back on slides. So those are the tips and tricks there for kind of making sure you're doing everything on a regular basis. And then I will jump back to the balance sheet just to kind of talk through that guy again a bit more. Debits and credits. Debits and credits always kind of confuse people, especially if you're looking at a bank statement, because the bank statement, they're doing it from their perspective. Okay, so everything on your assets, so all of those assets there, those are all debits. And then your liabilities and your equity, for in this case, these are all credits. So your assets, the total assets is $76.39, and then the total liabilities and equity are also $76.39 because they're credits. So if there was ever a time when you have overpaid somebody, so your accounts payable now is somehow in a debit, technically that's not an accounts payable now. It's a credit to them. So they actually owe you that money back. So it would go into your asset side because that's the debit side. So that kind of hopefully that, answers it a little bit more, that generally you want all your assets to be in the debit side because that means, hey, that's how much money I have in the bank. That's, how much money people owe me or what stuff is worth, like the net book value, that's what it's worth. And then liabilities is what you owe to everybody. And it's definitely better to have your assets that higher than your liabilities, because that means you have more money to pay for, everything that you owe to somebody else. But when you add your liabilities and your equities together, they have to equal your assets because they are the total credits. And then the assets are your total debits. So that equity section is kind of just whatever's left over. If I pay out, I get all the money back from all my customers. I sell off that furniture and those computers and that's gone. So now whatever's left in the bank, that's the money I have. I pay out all my liabilities. So then whatever's left is going to be my bank and then the equity. So that kind of balances each other out. Donna, if that's still kind of confusing you, we can get in contact later, and we can spend a little more time going through debit and credits at a later time for sure. For this process between corporations and sole proprietors does not change a lot. Kind of the only difference is just in like your tax brackets. So I think there was a question there about how much you set aside. For personal taxes, it jumps depending on how much money you're making in the year. So it could be anywhere from, 20% up to 48% would be in the highest if you're making, a whole lot of money. So you're gonna, it's hard to say how much you should put aside for tax purposes. Because there are many different tax brackets on the personal side. But if you're making over $200,000 on a regular basis, you're going to probably want to incorporate because it's only 13% tax, whereas if you're over 200, you're going to be paying 44% tax personally. So if you're in the lower brackets, it'll be about the same. It'll be around like 13 to 26 kind of thing, depending on how much money you're making. And then you're not necessarily going to have retained earnings in your equity or like a shareholder's loan. It's just the money that you're putting in. It's still all your own money. It's just, it's such a hard one to explain. You might have to kind of think about a better way to throw that in there. But the process is all still the same. Between a corporation and a sole proprietor, because you still need to know how much money that you're making in the year so that you can report it on your personal tax return, but and then know how much money you owe to people and how much money people owe you. So I guess you wouldn't have dividends is kind of the main difference there. If you lose a receipt, but it's still on your bank statement, I would just kind of go with you're just going to do your best guess as to what type of expense it is. If you don't know how much, GST was paid, you could do the math and be like, okay, well, whenever I go and get gas, it's always, 5% GST. So then you could just do the math to pull out the ITCs that were paid. Or you could just be like, wow, it's gone. I'm just going to expense it all. All right. And the only time that's going to be a problem is if CRA does decide to come and do a GST review or an audit. If you don't have those receipts to prove it, they'll generally do the math and be like, okay, yeah, whatever's been collected is okay. or they might throw it out and be like, nah, you can't claim that GST. So it's okay if you don't keep them all, but try your best, I guess, to keep as many receipts as possible. So I think I've answered all you guys' questions in this little bit here. If there are any other questions, we have like another minute or so, or you can always just email them in to us, and we have like your contact information, so they'll get them to me, and then I can do my best to answer any other questions that you guys might have. Yeah, 24% is probably not too bad. That'll be fairly comparable depending on how much money you're making each year. So, and then hopefully you have other amounts that you can deduct against it, so that'll help you out there. All right. Well, I think if that's everything for now, we'll, like I said, send emails and I can help you out, in the future. All right, Josie.
All right. Well, thanks, Denelle, for taking some time to share that accounting and bookkeeping expertise with us. I'm sure we all really appreciated that. Thank you to everyone else who was able to join us today as well. I hope you guys learned something that can help you in your bookkeeping ventures. You will be able to view this webinar on our website on demand within a day or two, so keep an eye out for that if you want to watch it again. Our next upcoming webinar is titled How to Finally Succeed with Budgeting, and will happen on September 18th, and is presented by Mandy Thomas, a financial coach at Mandy Thomas Coaching. Registration for that is now open. You can check your WESC emails or visit our website to register at any time. All right, goodbye everybody, and have a great afternoon.